This is your technical update from the LMAX Exchange Research and Analytics Desk for Friday, March 27, 2015. Euro dollar. So the euro correction extended all the way up to 10.52, 10.53 on Thursday before reversing sharply to put in a bearish outside day formation. This formation has now ended a sequence of consecutive higher lows since the market based out back on the 13th of March by those 12-year lows at 104.62. At this point, to see a lower top carve out and a resumption of the downtrend, a break back below the low that we saw on the 23rd of March at 107.67 would be required to strengthen this outlook and accelerate declines back towards that base. However, a break back above the high from Thursday at 110.53 would negate and open the door for additional corrective activity. At this point, though, the downtrend remains firmly intact and only back above 15.35, 15.34, the high from the 3rd of February, would negate the downtrend. Sterling dollar. So cable has been in the process of consolidating just off the recent multi-year lows at 46.35, and the market's going to need to break either above 51.65, a recent high, or back below 46.35 for the next clear breakout. But a break below 46.35 is favored given the underlying bearish downtrend, and this break would open the door for the next major downside extension towards the psychological barrier at 140 further down. At this point, even if we did break above 51.65, a break back above the lower top that we saw back on the 26th of February in the 55.50 area would be required to force a shift in the bearish outlook. Dollar yen. So dollar yen had a nice pullback on Thursday, trading all the way down towards some key support at 18.23 before finally being supported and rallying back into the close. At this point, the overall outlook continues to be highly constructive, with the market eventually favored to trade back above the recent high at 22.03 and towards the 125 to 130 area further up. Any setback should continue to be very well supported into the 117, 118 area, while only back below 115.55 would give reason for concern and delay the highly constructive outlook. Euro Swiss. So Euro Swiss has mostly been in the process of trading lower over the past several days, basically since the mid-February time when the market put in a 108.15 high, well, and traded back all the way down thus far just shy of 104.15. At this point, 104.15 is critical support, and if the market can hold above that level, the recovery outlook is still intact with a higher low sought out ahead of the next upside extension above 108.15 and towards the 110 to 112 area next. A close below 104.15, however, would compromise the current recovery outlook. Aussie dollar. So Aussie dollar gains have stalled out this week after the market traded briefly above the 79 level. The market is still locked within a very well-defined downtrend, and so any rallies should continue to be very well capped in favor of a fresh downside extension below the recent multi-year low at 75.60 and towards the next key psychological barrier at 70 further down. At this point, only a break and close back above 80.25 would compromise or delay the bearish outlook. Dollar CAD. So dollar CAD has roughly been consolidating in recent trade, though the market did put a fresh 5-year high in last week at 128.35 ahead of this latest pullback. But again, given the broader structure, this consolidation is classified as a bullish consolidation ahead of what should be the next major upside extension above 128.35 and towards the 130.65 2009 peak. At this point, only a break back below 123.50 would delay but not negate the recovery outlook. If we do see a break below 23.50, that would likely open the door for a more significant correction down towards the 120 area from where a higher low would be sought out in favor of a bullish resumption. Kiwi dollar. So Kiwi remains locked within a well-defined downtrend, and though we have seen this week a break back above some key resistance in the 76 area, the market has been unable to hold on to those gains, and a lower top is sought out ahead of the next downside extension below key support at 71.76 and towards next key major psychological barriers at 65 further down. At this point, only a break and close back above 78.90 would give reason for concern. SPX 500. So the S&P 500 has recently stalled out after trying to take out that recent record high at 2120 from February, and the market topside failure now exposes a retest and break of key support at 2040. If the market can take out and close below 2040, that would be a significant development and suggest that a meaningful top is in place ahead of a fresh acceleration to the downside back towards 2000, and then below there potentially exposing a move back to that October base at 1820 further down. But at this point, again, a break and close above 2040 would be initially needed to suggest such a topping structure. Inability to take out 2040 will keep the immediate pressure on the top side with a potential retest and break of that record high at 2120. Gold. So gold has put in a very nice recovery over the past several days since stalling out just shy of that critical 2014 base, with the market rallying all the way back above 1200 thus far. But there's some key resistance in place from the 2nd of March at 1223, and this resistance will need to be taken out to really confirm the basing outlook here, or the prospect for a material base in favor of additional upside over the coming weeks and months. However, inability to take out 1223 will suggest that the market is wanting to put in maybe a lower top ahead of a retest of that 1131 base. So 1223 is key here, and look for a break back below the recent low that we saw in the 1185 area to put the pressure back on the downside. That's all for now.